As always, Gautam Duggad is now joining us, Head of Research, Institutional Equities at Motilal Oswal Financial Services is with us. Gautam, great to have you back on the program. Thank you very much for your time. So just a first take on corporate earnings. I mean, the last time we spoke with you was exactly what, I think a week and a half back, basically, but numbers were still coming in. But now you have a full bird's eye snapshot view. How has the earnings season been? And what does it mean, if anything, for full year earnings upgrades or downgrades?
Hi, Prashant. Good afternoon. Thanks for having me. So the corporate earnings, if you look at, you have to look at it through two different lenses this time. If you look at aggregates, they are slightly underwhelming because of the big disappointment in some of the cyclicals and heavyweights like Reliance, Tata Motors, and OMCs. So if you look at aggregates without excluding anything, Nifty earnings are up 23%. We were expecting a 30% growth. And our coverage universe earnings were up 12% versus expectation of a 20% growth. But if I look at Nifty by taking out two loss-making companies, which is BPCL and Tata Motors, the growth is around 31%, which is in line with expectation of about 34%. And if you look at, again, the same aggregates excluding commodities like oil and gas and metals, earnings are up somewhere about 35%. So while the aggregates may give you a sense that this has been a slightly disappointing quarter, but if you look at the internals and the spread of the earnings, it's been fairly okay, in the sense that 70% of our coverage universe has either met or have beaten expectations. 14 out of the 20 sectors that we track, again, have beaten expectations or have met expectations. So the spread and quality of earnings is far better this time. Upgrade to downgrade ratio is even Stevens. We have seen about 80 companies with earnings upgrade of more than 3% for FY23. And similar number of companies with a downgrade of more than 3%. And as far as forward estimate revision is concerned, we have taken a cut of about 3% for FY23. So entire 3% cut has happened because of the earnings cut in ONGC, Reliance and BPCL. Rest of the 47 pack put together are roughly stable. So our new EPS is at about 845 rupees for FY23. We were at 865 when the quarter began, when the preview happened. And for FY23-24, we are still at about 1,000 rupees. Okay. The only thing slightly concerning right now is large part of the growth, or in fact, the entire growth this quarter has been driven by financials. X of financials, our broader coverage universe, there is no growth. And for Nifty, the growth is about 18%, which is slightly underwhelming versus the expectation of about 27-28%.
Okay, all right. Hi, Gautam. Good to hear your thoughts. Gautam, what's the downside risk to this 845 rupees? You've cut it by 20 rupees. The fear is from here, the going's going to get tough. Quarter 2 should be a little bit softish, but the hope is that recovery from the second half of the year. What's the downside risk to this Nifty EPS number that you have of 845 and 1,000?
So Nigel, when I look at the next 3 quarters, because we split the earnings into 4 quarters right at the beginning of the year, our full year growth expectation is 15%. First quarter itself was 23%. So rest of the 3 quarters have a slightly modest expectations of about 12-13% growth. Because now the base will also catch up. Do remember that FY22 full year corporate earnings specifically for Nifty were up about 35% in terms of EPS and 40% growth in terms of absolute profits in FY22. So on that high base, we are talking about a 15% growth in FY23. Rest 3 quarters, our average is about 12-13%. As far as downside risk is concerned, it can emanate from anything here. I mean, we didn't know that crude will go down by $30-40. And it will have an impact on ONGC numbers and Reliance numbers. In fact, counterintuitively, higher inflation and higher commodity prices have actually worked in favor of Nifty. If you look at the earnings projections over the last 12 months, wherever you have seen commodity price inflating, you've seen upgrades in metals and oil and gas, which is 30% of the profit pool. Now that commodity prices are receding, some of the other segments of the market like auto, consumer, cement may see a slight bit of a breather on margins. But the profit pool contribution of metals and oil and gas is still quite substantial, and therefore they may take a knockdown. So a lot depends on where oil settles on a full year basis. But yes, there does exist some sort of a downside risk. But at the same time, you've now seen in the last 30-35 days, bond yields have pulled off. So this quarter, financials took a hit on their operating profits because of treasury losses. So some of them will get returned back in the second and third quarter, depending on what is the size of the book and how it is positioned. So there is a cushion available. There are multiple moving parts, as always, when you look at a broader index. but I think we should settle somewhere about 820, 830 for FY23. So maybe 2-3% more downside risk to the earnings.
Okay, Gautam, the big mover post the earnings has been Bajaj Finance, even Bajaj Finserv actually. What's your view on these names? Because these are large stocks, and the way they moved, I know there's been some FI buying which is back, but has it surprised you, the move?
I think they deserve that moment, Anuj. If you look at the quality of earnings, the kind of AUM growth they're guiding for, asset quality, in fact, all the concerns that we had a year and a half back when the pandemic began, that growth will take a knockdown, asset quality will deteriorate. None of that has panned out. And not just for Bajaj Finance, Anuj, it's been the case for all the large cap financials, whether it is a bank or an NBFC. The last 2.5 years have been a dream run for banks' profitability. You've seen almost a 4x jump in Nifty Bank's profit from FY18 to FY22. And on that FY22 number of 1.5 trillion, we are talking about 1.9 trillion for FY23 BFSI profits. So I think the kind of movement that you're seeing in some of these names, they actually deserve that. Secondly, the concern on growth has receded across the board. So a few months back, a lot of the growth stocks or the high quality stocks were taking a knockdown, because suddenly there was a shift towards value. But with yields coming off, inflation picking out, and growth outlook getting better, a lot of these stocks, spanning across spectrum, whether you look at consumer discretionary, names like Pidilite, Asian Paint, or QSR, where things like Jubilant, Sapphire, a lot of those things, Page, they all seem to be doing well. The moment market again starts gravitating a little bit more towards growth, or the value positioning that we had seen come into reckoning in the last 1.5 year.
Gautam, this entire FI buying which has come back, I mean, in the last month and a half, there have been buys of Indian equities worth about $3.5 billion or so. And the index is already just about 3.5% from all-time highs. Now, the fact is, bulk of the selling, I'm assuming, happened in financials and IT, right? Which are still far away from being near the respective highs. So how is this largely going to play out in your assessment? I mean, when you speak with foreign clients, etc., where are they looking to buy stocks? Where is the interest, and what are they making of the market now?
You're right, Prashant. For example, if you look at the FI holdings in India, we did this report a month back when the June shareholding data was released. So they have about $560 billion. Of course, you can add 5-6% more given the market rally which has happened. So out of $560 billion of their overall FI holding in India, around 37-38% is financials and about 16% is IT. So the two sectors together comprise 53-54% of their total holdings in India. And then you have consumer, reliance, and auto, which account for another 20-22%. So between these 5 sectors, they have about 75% of their portfolio, very concentrated positioning. So it's but natural that when they sell, which they did from October to June of about $35 billion, you saw a disproportionate impact on these two sectors. And now with the semblance of buying coming back in the last 1.5 months, you are seeing some of those spaces bouncing back. What can happen in future, very difficult to tell which way they will be moving, whether they will be buying or selling. But can be rest assured that the movement will get disproportionately reflected in these two sectors. If they're buying more, obviously BFSI and IT will benefit. And if they're selling more, these two sectors will bear the brunt of that selling.
Okay, by the way, just look at the market. All of a sudden, there's a sharp uptick in the bank Nifty. And just look at HDFC Bank's intraday chart. In fact, both HDFC Bank and HDFC, through the day, these were the only stocks which were sulking while the market was doing so well. And now HDFC Bank has moved to high point of the day, and HDFC as well has moved to high point of the day. So big moves happening in both these names. The Nifty is at 17,957. I don't think there's enough time for it to hit 18,000 today. But sometimes these events, these things get taken out with a gap because otherwise there's always this program trading or algo trading which makes people book profit at around 18K. So it will be interesting to see if we have just semblance of decent global cues. Tomorrow morning, perhaps we could be looking at a date once again with 18,000. Remember, October 2021 is when the Nifty had hit 18,600. From that point, we had that correction in the market, and now we are almost back to 18,000. Gautam, any view on the HDFC twins? Because they have underperformed for almost 2 or 3 years now. Do you think that will continue, or will they sort of make good for the underperformance like they normally do?
I think they will make good for the underperformance, Anuj. There is tremendous value sitting in both of them. In fact, there's no point comparing both now because the ratio is well established. If you look at HDFC Bank itself, the profit growth has been excellent. Has been no dent on the asset quality. The fundamentals has been quite strong. If you look at the performance on the market cap, the last 3 years CAGR, Nifty is at about 17% and HDFC Bank has 10%. So there is a lot of catch up that HDFC Bank has to do in terms of relative gap. The fact over remains that the growth has been quite strong for them. In between, there have been a couple of quarters where the operating profit did moderate, but some of these things keep happening. You've seen even for the other banks in 1Q FY23, the treasury MTM impacted the operating performance. And now, the positioning has shifted completely. For example, if you look at the domestic mutual fund portfolios 3 years back, 17 out of top 20 mutual funds had HDFC Bank as the number one stock in their portfolios. Today, if you see the same portfolios, about 18 out of top 20 mutual funds in India have ICICI Bank as the number one positioning. So clearly, the sentiment has taken a bit of a knock given the recent underperformance, but I think the inherent and underlying value in that business remains intact.
Okay, all right, Gautam, thanks so much for stopping by and filling us in with your take on the earnings of the past quarter, as well as the way ahead as well. Well, before we slip into a short break, just pull up a couple of stocks. Oberoi Realty, I think we should pull up the intraday chart out there. The stock was down close to 2%. When we started off the show, I think it's recovered a little bit from the day's low. A sharp uptick is what we're seeing from the low point of the day. And a couple of other names. You have AB Fashion Retail as well, that's seen a bit of recovery. Havells as well has seen a bit of a spike up in the last few minutes. Keep an eye out on the broader markets. The Nifty is doing well, but the broader markets as well. A lot of stocks moving with good momentum. Slip into a short break, come back, and as always, we'll tell you what to buy today to sell tomorrow. Our technical experts will be back with us.